I'm suing. Man, I'm suing.
I almost got rich today.
What?
Okay? Stop sticking your hand in the jar. You get, man, listen. I'm not, I told you yesterday, I was out of selling the call business. So I'm going to talk about a real, actual investing and trading strategy. But I just can't. I can't. If that wasn't the most indescribable week um, I've seen in the stock market, and man, what in the heck is going on? Uh, crazy week, and I'm just glad that we made it through. Like we made it through. Nobody got killed, nobody got rich, so we still gonna be on this long road to profit. Speaking of which, this is the long road to profit. Thank you for joining your host, JR. Yeah. Like, subscribe. We want you to, stay in tune to what we doing up in here. But, yeah, it was a wild week. And I'm just looking forward to making some money this week. I'm going to make it somewhere. And clearly, the market overall doesn't like GameStop because I just checked just now. And, the NASDAQ futures is down almost 1%. Dow's down 0.5%. S&P's down 0.7%. So we at 7 o'clock on Sunday, January 31st. The market is still being nasty because GameStop is killing. So, hey, that was the worst week since October last week on the broader market. So for other people who don't just gamble in GameStop, that probably wasn't such a great week. But I want to talk this week and tonight about some stocks that I'm looking at for the next maybe 30 days or so. I'm trading daily charts, so I'm going to kick into what I'm looking at and what's my position on AMC. I took a cover call position. It's not really showing where I got the stock at, which is around. I mean, the stock price that I bought it at was around this stock price $13.46. I could go over there and look, but it's not really that important. I guess just so you to get a understanding of what I'm trying to accomplish. So normally, let's just start off with, okay, normally what I'm looking for in a trade, an options trade, is I'm looking for about 45 days to expiration, in that range ish. Okay. Typically, I'm looking to be a seller of options, not a buyer of options. So most of the stuff you're going to see me doing, that comes from Tasty Trade. They got a whole philosophy over there about how you should conduct yourself in options and really be looking to act as if you're an insurance company. Basically taking risk and assuming that the probabilities are in your favor, you'll be a net winner. So it's not a quick get rich, scheme or anything. Nothing like buying options, which buying options typically you can see some of those massive returns. And that doesn't mean that I don't buy options ever. But typically I look to be a net seller. So on Friday, I sold 5 call options for February 5th expiration. Okay. And at the $20 strike. So I collected some decent premium on that. I believe when I collected this, it was around like 380 ish. So right now the bid ask is a little bit less than that. So in any case, I use E-Trade, and part of the reason I like to use E-Trade is because I really like to know what's my probability of profit, probability of making money. And so in this strategy, where I'm, basically I'm bullish on the AMC, I've got, as you can see here, a 79% chance of making money on February 5th if I hold the options to expiration. First, let's just, talk about what it means to be a seller. So for being a seller, if you're not familiar with options, being a seller, it means that I collect the premium rather than pay the premium on the option. So if I'm telling you that it was $3.80, right, and each option contract is worth 100 shares, right? So you can take that number right there, $3.80, or it's not right here, but that's what I sold it for, $3.80. And you multiply that times 100, and that means that I get $380. Okay, $380, right? So I get that 5 times. Okay, so if on February 5th the price of AMC is below $20, I'm going to keep that $380 times 5. I'm going to keep that, okay, which is, I don't know, $1,800 or so. I'm going to keep that money. If it's above $20, then I run the risk of my options being exercised, and in that case, I would have to pay, or it's not pay, I would have to provide the stocks at $20, the $20 strike price. Okay, so if it was $25, obviously I still have to get them the stock for $20, which means I eat the difference and I lose money. That doesn't happen, however, if I own the underlying stock. So this is what is called a covered call. So I own 500 shares of AMC, but I also sold 5 call options against the stock. What that has the net effect of lowering my cost to own the stock. Okay, so instead of having to own it from $13, now I got that premium, so I can actually own it for less. If you look here on this chart, it'll kind of show you even if the price goes down, and I'm at like $9. I'm just trying to log me out. On February 5th, I still make money, even though I lost money in owning the stock. And I actually, in this case, I want AMC to go up. If AMC is $20 or more on Friday, good for AMC, right? I still make $5,000. Okay. If it gets crushed, and I won't let it get crushed. If it went down at $5, I'm gonna lose $2,100 ish. But you can kind of play with this in E-Trade and kind of, work with different scenarios so that you understand exactly where you're at. So it lowers your cost to own the stock. It's a bullish position, but I'm not taking unlimited risk to the upside, so there's an advantage to that, and that advantage plays itself out in giving myself a 79% chance of profit. Now, on this particular stock, I'm going to say that 79% doesn't really mean that much to me. And why is that? Well, all we got to do is go over here and look at AMC's chart. Like, if you look at this chart, there is, from a technical standpoint, it's all over the place, right? And so to say where it's going to be, it was down here at 2, right? And then went all the way up to dang near 20. So it's a big risk, and you got to watch AMC. I'm gonna have to watch AMC throughout the week to manage that trade, to try to make sure that I still come out with profit. But at least in E-Trade's view, it's a 79% probability of profit on February 5th. So that's where I stand on AMC. You trying to log me out on all the ones. Let me move over here. Okay, so here's the other trades I'm looking at for this week. And this is not a this week trade. This is this is a normal option trade for me. So again, I'm a net seller. These are naked positions, and naked positions, technically you have unlimited loss potential, because the stock could, Visa could just, take off and go to the moon. I highly doubt that that's going to happen with Visa, and this is where, like I say, it comes in about being more of like an insurance you know, person, you know, insurance broker where you're basically letting other people take the risk, or excuse me, you're assuming the risk of an extremely volatile move in the market, and for assuming that risk, you get to collect the premium. So why do I like Visa right now? So I like Visa for a couple of reasons. Number one, I like Visa because there's more premium in the options. So and that's a function of volatility. So when I use my little market chameleon, I go over here and I'm looking. Let's see, where's Visa at? And here's Visa. Okay, so Visa, obviously a massive market cap company, has an IV30 of 33. Okay, that's a decent IV. I like to see IV anywhere from 20 and above, and that's another kind of tasty trade. You see, there's a lot of high volatility rank and these are the largest companies. So number one, there's a higher premium. So I like that about Visa. I look over at my chart, and this is my little trading view chart that I got set up with the profit maximizer. I keep charts pretty simple. This does give us some indicators here on buy and sell. Sometimes they're accurate, sometimes they're not. Sometimes I use them, sometimes I don't. Right now, this is a neutral trade, so I'm not really looking to, you know, try to pick a direction. What I'm trying to do is, okay, so Visa had a recent high here at 220, all right, and so looking at Visa's chart in the next 45 days based on their past movement, and you can see the chart down here going back from June, July, August. Visa is not one of these stocks that's just been moving crazy. Now, he got some big volatility here in like October, November, where it had a big move, but most of the time it's been in a pretty good range. So what I'm betting on is that it's going to stay in that range. And so you look at my trade, what I had, I was selling a call for March 19th at 220. So that means that if it's below 220, again, I'm making money. And I'm selling a put at below 170. So, you know, based on, and it ended Friday at 193. So I'm pretty even between the two. You know, a little bit more room to the upside because I still think that we are in a bull market, although the market may be starting to correct. So maybe I have to change my assumptions, but at right now the thesis is we're still in a bull market, so Visa can go up. So for this trouble, I'm collecting a premium of $3.89. Okay, $3.89 is the premium, which means I'm collecting $389 net. All right, if I took the bid, now I'm gonna probably look to get a spread between the bid and the ask tomorrow. But as you can see, and this is what's called a strangle, I've got an 81% chance of profit. So I'm looking at this trade for tomorrow. My max profit channel is $387. So, or at least that's what the if I took the net premium. If I get more premium, it'll be worth more than that. And you'll see if I kind of move these tickers, and you see, you know, what it expects to say that your options are worth tomorrow. So tomorrow it's gonna look like I'm losing money, kind of no matter what, right? And if you take this out and you say Visa goes on some ridiculous run where Visa goes up from to 260, and I'll lose $3,000. But that is not likely to happen, and we're gonna bet on this 81% chance that Visa is gonna be between 170 and 220 come March 19th. And as long as Visa is, like I say, we will make a profit. And the key with doing this kind of strategy is not to do it one time, because obviously there are going to be outliers, and it's also not to not manage your trade. So you have to, I think, be paying attention when you start to see volatility pick up. Sometimes there's an opportunity way ahead of expiration to take profits, and oftentimes I do. Last trade I'm doing for tomorrow is I want to get into Qualcomm. I'm not there right now. Of course, you know, my mind could change. My mind could change based on you know, what the market looks like tonight, because let's go back over there and see. Yeah. They come back a little bit. So the Nasdaq was down a lot more earlier. I think it was down like 115, so it's down to 85. Maybe we'll see it come back tonight. Last one, Qualcomm. All right. So this is just a complex option. This is a custom option strategy that I set up here with a nice, again, I like to be in that range, 79, 80%. I like to be right there. So in this case, I like Qualcomm. I want to be long Qualcomm. All right. And this is a way for me to do it and collect a little premium. Now, I'm not collecting a lot of premium. Okay. But I can get long and collect some premium, managing my risk a little bit. So again, this is another strategy where if you look to the downside, yes, if Qualcomm crashes and that means I have to jump in and manage the trade, I'm in trouble. But let's just look at where Qualcomm is right now. So Qualcomm is at 156 right now. If you look at the daily chart, this is a beautiful chart. I like to be a trend follower, and you can see this chart. This is the daily going back to this is going all the way back to Feb, and so kind of after the crash, and you see it's just a steady kind of march up, and there's some decent swings here, but nothing crazy in the steady march up. And so what I like to see is, okay, this is a stock that is favored by the market. It's getting to a point on the RSI where it's a little bit over, so I think that it's got a chance to go turn around and go long after getting sold off, and tomorrow may be even better opportunity if the market is down to get in to do this trade. So what I'm doing, all right, 156, I'm selling a put at a 140 strike for March 19th. I'm buying a call for 180 on March 19th, and I'm selling a call for 195. And what that has the effect of doing is, I'm a simple person. I don't like to sit there and do all the math. The computer does it for me. So you'll see, even if stock goes down, right? Let's say March 19th is at 143. I still make $236. Okay. So, but I got $236 in this, in a whole range from 130, I think it's like 138-ish, 138 all the way to 180. Okay. I'm in a $230 some trade that's going to give me a defined amount of profit if it stays within that range. But like I said, I wanted to be long Qualcomm because I think it has a chance for another maybe jump up. So it's still a buy on my chart. If it goes up and possibly gets up to maybe that 200 range by March, I got me a nice $1,700 profit. Overall, I got a 79% chance of profit over the next 45 days. And these are the kinds of trades that I love to make. So this is a trade that I'll likely put on tomorrow. I'll be watching the market. I'll see what goes on in the futures. I'm still paying attention to, GameStop and AMC. So, hey, I appreciate you stopping by and getting through the episode. Now we just need to do a couple things. First, like, subscribe, and comment. Second, I am not a financial advisor, and this is not financial advice. If you're going to make a financial decision, I would advise that you actually seek out a professional for any of your investment needs.